Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Merck.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a really useful chart tool for investors and traders.
Yeah, you'll definitely want to hear this.
Right, so if you want help reading trading charts a bit more clearly, you can check out VIP Algos through the link below in the description.
Highly recommend it.
VIP Algos is a TradingView indicator suite. So it actually shows you visual buy and sell chart alerts right on the screen.
Which is incredibly helpful.
It is, yeah. Plus it has trend direction tools, support and resistance zones, and take profit and stop loss planning areas.
And you can use it on pretty much anything, right?
Exactly. It works across markets like stocks, Forex, crypto, gold, indices, futures, and, much more.
Awesome.
But just remember, VIP Algos is an educational chart analysis tool only. It is not financial advice. It does not place trades for you, and it absolutely does not guarantee profits.
Right, you still have to do the work.
Exactly. Trading involves risk, so always manage your risk and do your own research. And just a heads up, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
All right, let's move into the wealth building context for our talk today because, I want you to imagine a paradox here.
Okay, lay it on me.
Today, we're looking at a $300 billion, really slow-moving pharmaceutical giant.
Right, classic big pharma.
Exactly, like the kind of legacy company your grandparents might have owned just to collect the dividend.
Yeah, very traditional.
But yet somehow, this stock is currently being bought up by corporate insiders at 52-week highs, almost as if it were some hyper-growth tech startup.
It's wild.
It is. It's outperforming the S&P 500 by 19% year to date. And it's acting as this massive defensive anchor for portfolios right now, especially with all the escalating geopolitical volatility in the Middle East.
It really is a fascinating contradiction, because when you're looking to build long-term wealth, the ultimate holy grail is finding an asset that can do two completely different things at the same time.
Right. You want protection and growth.
Exactly.
Yeah.
You want to protect your capital when the broader market is panicking, but you also want to aggressively compound that capital when things are stable.
And you think this stock is doing both?
Oh, absolutely. What we're seeing here is pretty much a masterclass in both. We are looking at a fundamentally defensive stock that is somehow delivering aggressive fundamental growth.
That 19% outperformance is no joke.
Not at all. And you pair that with a highly reliable 2.61% dividend yield, which, by the way, is backed by 15 consecutive years of dividend increases.
Okay, right out of the gate, I have to play the skeptic here.
I wouldn't expect anything less.
Because when I hear words like, defensive stock, reliable dividend, and outperforming during geopolitical chaos, I immediately picture a hiding place.
Hiding place, right.
Yeah. Think of it like a high-yield savings account.
Yeah.
Sure, it's a perfectly safe place to park your money when the world feels unpredictable and scary.
True.
But nobody actually gets rich off a savings account. So my question for you is, are investors pouring capital into this stock because they genuinely believe in the future compounding of the business? Or are they just terrified of owning anything riskier right now?
See, that is the exact right question you should be asking.
Well, thank you.
But here's the thing. If this were purely a flight to safety, just a place to hide scared money, you wouldn't see the underlying top-line revenue expanding the way it is.
So the growth is actually there.
Yes. Yes, the defensive characteristics are very real. The sheer size of the company and that ironclad dividend are exactly what protect your downside during a crisis.
Right.
But the growth engine that's driving the stock higher, it isn't based on fear. It's based on a highly aggressive, highly successful pipeline of oncology treatments.
So it's an actual growth engine.
Exactly. You're basically getting paid a dividend to wait. But the business you are waiting on is remarkably dynamic.
Okay, that gives us the bigger picture. Now let's look at the fundamentals. Because if the growth engine is really that strong, where exactly is it coming from?
It's all about their moat.
Right, because a company of this sheer magnitude, they don't just grow top-line revenue by accident. It takes a massive catalyst.
It does. And to understand the growth, you really have to understand their absolute dominance in oncology. And specifically, you have to look at their flagship drug, Keytruda.
Right, Keytruda. We've talked about this before.
Yeah, it has essentially become a foundational therapy in immuno-oncology worldwide. And because of this specific drug, the company is generating a nearly 3%, 2.89% to be exact, year-over-year revenue growth rate.
Which is huge for a mature business of this size.
Incredibly resilient. But more importantly, the pricing power here is just almost unbelievable. We're talking about a 78.07% gross margin.
Wow. Over 78%.
Right. When you can command margins like that on a physical manufactured product, you have an economic moat that competitors simply cannot cross.
Hold on, let's unpack that margin structure for a second, because
Sure.
this is exactly where my analytical alarm bells start ringing.
Uh-oh. Here we go.
You just mentioned a 78% gross margin, which, yes, sounds fantastic on the surface. That basically means it costs them very little to physically produce the drug relative to what they sell it for.
Correct.
But when I look at the bottom line, the net margin completely plummets. It drops all the way down to 13.59%.
Yep, that's accurate.
And the trailing 12-month earnings per share sits at just 3.55422 FOC.
Yep.
Like, I mean, if I'm selling a product with almost an 80% markup, I should be literally swimming in cash.
You would think so, right?
Yeah. Why is only 13 cents on the dollar actually making it to the bottom line? Where's all that money vanishing to?
Well, if you were looking at, say, a software company, that kind of drop-off would be terrifying.
Right. It would be a huge red flag.
But for large-cap pharma, this is the exact blueprint for survival. That massive gap you're seeing between the gross margin and the net margin, that represents the lifeblood of their future.
Ah, R&D.
Exactly. It's all getting poured directly into research and development and SG&A. And the pharmaceutical industry, if you aren't spending billions of dollars today to discover the next blockbuster drug,
You're dead in the water.
your business won't just slow down, it will effectively evaporate in a decade.
Because of the infamous patent cliff.
Precisely. The patent cliff is the absolute boogeyman of big pharma. Eventually, the patent on a money-printing drug like Keytruda is going to expire.
And then what, the generics come in?
Yep. Cheaper, generic biosimilars will immediately flood the market, and that wipes out your 78% margin overnight.
Ouch.
So that 13.5% net margin isn't a sign of corporate inefficiency or some kind of waste. It's actually a sign of a company aggressively reinvesting its massive cash flow to defend its future empire.
Okay, that makes sense.
And this brings us to what might be their most brilliant defensive maneuver yet. It's a formulation called Keytruda QLAX.
Okay, I've read a bit about this. This is the subcutaneous formulation, right?
That's the one.
They're transitioning away from the traditional IV drip?
Spot on. So the main composition of matter patent for the original Keytruda is going to expire later this decade.
Right, the cliff is coming.
Exactly. So anticipating that cliff, they are rolling out QLEX. Instead of a patient having to sit in an infusion chair hooked up to an IV for an extended period, QLEX is a quick, convenient subcutaneous injection.
Meaning under the skin.
Exactly.
Yeah.
And by transitioning patients to this new method now, they are creating immense switching costs.
Ah, okay, wait. Let's make sure we clearly define that mechanism for everyone listening.
Go for it.
Think about the actual patient experience here. Right now, a cancer patient has to drive to a clinic, get a needle put in their arm, and basically sit in a chair for hours while cold fluid drips into their veins.
It's exhausting. It takes up half their day.
Right. But then the doctor comes in and says, hey, great news, we have a new version. You come in, you get a quick shot under the skin, and you can literally go home in 5 minutes.
The convenience is life-changing.
Exactly. And once a patient is used to that 5-minute shot, what happens when the original IV drug loses its patent?
Right. A cheaper, generic IV biosimilar hits the market.
But no doctor, and certainly no patient, is going to want to go back to sitting in an IV chair for hours just to save the insurance company a few bucks.
Never. The convenience is the moat. It effectively extends their monopoly and protects that massive gross margin well beyond the original patent expiration.
I mean, it's kind of like Apple changing the charging port on the iPhone.
Oh, that's a great way to put it.
Right. You create a new hardware standard, a new delivery mechanism that makes the old, cheaper third-party alternatives feel entirely obsolete. And that keeps everyone locked firmly inside your ecosystem.
That is a perfect analogy. And believe me, the market absolutely recognizes how powerful that ecosystem lock-in is.
Well, that recognition brings me to my biggest hesitation here, which is the price tag of the stock itself.
Let's hear it.
We are looking at a market cap of over $305 billion. It's currently trading at a PE ratio of 34.15 and a price to book of almost 6.65.
Yep, it's steep.
I mean, a 34 multiple on a mature pharmaceutical giant, that is a massive premium. Are investors just overpaying for the illusion of stability here?
Well, a multiple of 34 certainly leaves zero room for sloppy execution, I'll give you that.
And all.
the market is absolutely charging a premium right now, but
Yeah.
they're willing to pay it because the cash flow is highly predictable, the dividend is ironclad, and the clinical trial results just keep delivering.
So they feel safe.
Exactly. The market is essentially saying we will pay top dollar today because we have crystal clear visibility into your earnings for the next 5 years.
Okay, that gives us the business picture. Now let's move to the catalyst timeline. Because if the market already knows about this QLEX strategy and they are already paying a premium multiple for it, what actually moves the needle on the stock price in the near term?
You want to know the spark.
Right. What's the immediate spark?
Well, the most significant immediate event literally just happened. On July 10, 2026, the FDA approved Keytruda and Keytruda QLX in combination with a drug called Padcev for the treatment of muscle-invasive bladder cancer.
MIBC, right.
Exactly. And this is a massive development. It broadens their total addressable market significantly into a very challenging oncology space.
Hold on, though. If the FDA approval dropped on July 10th, 2026, that's public knowledge now.
It is.
It's old news. Isn't this already entirely priced into that sum 4 multiple? Like, how much runway is actually left from a single catalyst that has already made headlines across the entire financial world?
See, it's a very common trap to think an FDA approval is the end of the story.
Oh, really?
Yeah, the approval is just the starting gun. The actual race, the real catalyst runway is the commercial execution.
Selling the drug.
Exactly. When they report their upcoming Q2 earnings in late July or early August, Wall Street isn't going to care about the initial press release anymore.
They'll want the numbers.
Right. They will be hyper-focused on the actual volume growth. How fast are doctors actually prescribing it? How quickly is it getting integrated into the national oncology guidelines?
Oh, okay.
The approval just sets the new baseline, but the actual revenue realization over the next 24 months is what will actually drive the stock. And furthermore, there's a really powerful macro catalyst acting as a tailwind right now.
Right, you're talking about the geopolitical rotation.
Yes. The recent U.S. strikes on Iran and the escalating tensions across the Gulf states are causing some severe institutional anxiety.
Oh, absolutely. Everyone is on edge.
Right. In an environment where the broader market feels incredibly fragile and unpredictable, large-cap, dividend-paying healthcare stocks experience a massive flight to safety rotation.
They become a magnet for cash.
Capital systematically rotates out of high-beta technology stocks and flows directly into these predictable cash flows.
Okay, so catalysts tell us what could change the story. Now let's pivot to the chart itself. Because you have this perfect storm, right? A huge total addressable market expansion with the bladder cancer approval, plus a macro environment literally pushing capital into defensive safe havens.
It's a totem mix.
How is that actually manifesting in the price action? What does the price structure look like today?
So currently the stock is trading right around $123.54.
Yeah, okay.
It was down about 1.22% on the day, but let's zoom out to get the real context here.
Always have to zoom out.
Exactly. It is up 17.37% year to date and up a staggering 47.04% over the last 52 weeks.
Oh, wow. 47%.
And it's sitting just 5.2% below its June 30 high of $130.29.
So it's holding its ground.
Yes. And what is crucial here is how contextualizing those numbers completely changes the narrative. This isn't some beaten down stock trying to scrape its way off the floor and recover from a crash.
Right, it's pushing highs.
This is a stock methodically pushing the ceiling. When you look at the multi-week returns, up modestly over 13 weeks, up 16% over 26 weeks, this is not a parabolic, speculative meme stock spike that's just going to collapse tomorrow.
It's institutional.
Exactly. It's a steady institutional accumulation phase.
And what really stands out to me on the chart is the volume behavior during these current pullbacks.
It's very telling, isn't it?
It really is. When the stock dips, the volume is completely normal. It's sitting right at its 1/10-day and 3-month averages.
Right.
That tells us this is low conviction selling. It's just the market taking a normal breath, not some panic distribution where institutions are rushing for the exits.
Exactly.
But here is the absolute wild card. And honestly, the mechanism behind this is the most bullish thing we've discussed so far today. I'm talking about the insider action.
Oh, man, it really is staggering when you dig into those numbers.
Right. Over the last 90 days, corporate insiders have bought a net 651,913 shares.
Massive.
And the management sentiment purchase ratio is sitting at a perfect 100. And here is why you listening need to pay attention to this. They're buying near 52-week highs.
Which is so rare.
Usually when you see a CEO or a board of directors loading up on their own stock, it's because the stock just crashed like 40%.
Right. They buy to show confidence and stop the bleeding.
Exactly. They are trying to catch a falling knife. But when management is dropping millions of their own dollars to buy shares when the stock is already up 47% for the year.
That's not damage control.
No, that is greed. That is them screaming that they believe the stock is still undervalued relative to what's coming.
Exactly. Cluster buying at the highs is incredibly rare in the stock market. It signals supreme confidence in the clinical pipeline and the commercial rollout of QLEX that we just unpacked.
They know something.
Well, keep in mind, these insiders see the internal prescription data, they see the clinical trial results, and they see the revenue projections long before we ever do.
Okay, so the chart gives us price structure and the insiders are buying. But what does the overall market sentiment look like? If the C-suite is screaming that this is a buy, what is the rest of the market saying?
Well, the quantitative sentiment scoring is distinctly bullish.
Okay.
But what is most telling to me is how the stock reacts to negative news.
Like the macro stuff.
Exactly. We have headlines reading things like futures fall after strikes or markets slide on oil fears, and yet the specific news sentiment for this stock remains completely untouched.
It just ignores it.
Pretty much.
Right.
The market has collectively decided that this is the designated stable asset amidst all this geopolitical chaos. The FCA approval news is obviously driving the bullish narrative, but its absolute resilience to bad macro headlines is what really confirms the underlying strengths here.
Are there any speculative flows underneath the surface, like any M&A rumors?
Currently,
Oh.
no. There are no hard merger and acquisition rumors right now.
Gotcha.
However, looking ahead, as we get closer to the end of the decade and that patent cliff becomes a stark reality across the entire sector, you can absolutely expect speculative chatter to pick up.
Because they have to buy growth.
Right. Big Pharma traditionally tries to buy its way out of patent cliffs by acquiring smaller, innovative biotech firms to refill their pipelines. So any hints of them acquiring new assets will likely act as a speculative catalyst down the road.
I have to push back here, though.
Okay, hit me.
Is everyone getting a little too comfortable?
What do you mean?
Well, when you have a stock that is universally deemed the perfect safe haven, and insiders are cluster buying at the highs, and the sentiment is just uniformly bullish, isn't that usually when the market is ignoring a massive blind spot?
The crowded trade theory.
Exactly. When everyone is standing on one side of the boat, that's exactly when it tends to capsize.
That is a very fair point, and it's why we always have to look at the downside.
So let's talk about the risks.
Right. Because that sentiment picture is incredibly rosy, but the risks are very real.
The downside is what worries me most, specifically circling back to that valuation.
The 34 multiple.
Yes, a PE ratio of 34.15 means the stock is priced for absolute perfection. And perfection leaves absolutely zero room for execution errors.
None.
Let's say they miss their upcoming Q2 earnings estimates by just a tiny fraction. Or what if the Keytruda QX rollout hits some minor manufacturing snag? Or what if doctors are just simply slower to transition patients away from the IV than anticipated?
If any of that happens, that 34 multiple is going to contract violently.
Right. And we need to clearly define multiple contraction for everyone listening because it's a silent killer for returns.
It really is.
The underlying business earnings don't even have to collapse for the stock to fall.
Yep.
If earnings just stay flat or the growth rate merely slows down, investors will suddenly decide they're only willing to pay 20 times earnings instead of 34 times earnings.
And down it goes.
The multiple shrinks and the stock price plummets even if the company is technically still profitable.
It's the primary valuation risk here. At these price levels, you are absolutely paying a premium for quality, and that premium demands flawless commercial execution.
We also have to address the macro volatility risk.
Yeah, the geopolitical stuff.
Yes, they are a defensive healthcare company. But if the geopolitical situation deteriorates further, and we see genuine, sustained threats disrupting global energy supplies, like in the Strait of Hormuz.
Which would be catastrophic.
Right. If the broader market experiences a severe liquidity-driven crash, this stock is not immune.
Not at all.
It's trading near multi-year highs. If massive institutional funds suddenly need to raise cash to meet margin calls in a panic, they will sell their winners.
They'll sell whatever's still green.
Exactly. They will sell this stock just to get liquid. In a true panic, all correlations go to one. Everything gets sold.
That is a very grounded perspective. The risks are entirely present, and anyone looking at this needs to carefully weigh that potential multiple contraction against the incredible moat they've built.
Exactly. And in navigating these exact risks, visualizing those multi-week uptrends, identifying normal volume pullbacks versus panic selling, and finding those crucial support levels where a multiple might contract down to that is exactly why having a clean workflow is so important.
Absolutely.
And that's the entire point of educational tools like VIP Algos. It helps cut through the noise so you can actually see the structure forming on the chart.
It really helps clarify things.
Again, you can check out VIP Algos through the link below in the description. It provides visual buy and sell alerts, trend direction tools, and TPSL planning areas. Just remember, it is an educational chart analysis tool only.
Right.
It is not financial advice. It does not place trades for you, and it does not guarantee results. Trading involves risk, so please always do your own research. This is an affiliate link, and we may earn a commission at no extra cost to you.
Good reminder.
So, with everything on the table, the massive QLEX moat, the FDA catalyst, the insider buying, and the very real risk of that high valuation multiple, what is the final verdict?
Based on the full analysis, this earns a bullish score of 8 out of 10.
8 out of 10, okay.
The target horizon here is a multi-year hold. This is currently positioned as the premier risk-adjusted play in large-cap healthcare.
It's definitely a powerhouse.
You have a company firing on all cylinders. There is aggressive top-line growth driven by the continued dominance of Keytruda. You have the recent FDA approval expanding their reach into bladder cancer, and a brilliant strategic pivot to subcutaneous formulations to defend their massive margins.
And the insiders.
Exactly. When you pair all of that with highly unusual insider cluster buying at 52-week highs, the long-term thesis remains incredibly strong. Provided, of course, that you can stomach the risk of a potential multiple reset if growth slows down.
Always a catch.
Always. And of course, a clear reminder to you listening, this is not financial advice, it's just an analysis of the data in front of us.
Right.
But I do want to leave you with a provocative thought to mull over.
Okay, let's hear it.
We spent a lot of time today talking about the famous patent cliff that absolutely terrifies the pharmaceutical industry.
Right, the boogeyman.
But if this subcutaneous strategy, using a new delivery mechanism like QLEX to retain patients long after the original drug patent expires, if this proves wildly successful, will it completely redefine how big pharma operates in the 2030s?
That's a great question.
Are we witnessing the death of the traditional patent cliff?
Definitely something to think about. And if you found our talk today useful, please consider subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.